Okay, so again, I would not trade it because it is not in the trend. It's not in the direction of the trend. But suppose it was in the direction of the trend, the basic rules-based approach would be to sell. Suppose again it was in the trend. Sell below level 1, hedge to internal resistances above level 1. Okay, so I would sell level 1. This is now a level 1. Sell, this is resistance 1. This is resistance 2. Why not consider this is resistance 1 and this is resistance 2? They're of course the same levels. Why not this is resistance 2? I take the best so that I don't get chopped. And this means I will also take the best entry. Again, assuming this is in the trend, not counter trend. So I'll wait for a bounce to 1.1368, 1.1370, short it. I'm going to protect it. I'll look for that protection before I look for the target. I'm going to protect it at 1.14, right? Between 113.70 and 114 is just 30 points. Again, I'm selling level 1. I'm hedging above level 2 or level B in this case. And I am very cautious. I don't want to take an early hedge, so I have even one higher resistance above level B. I'll begin my protection, 1.14. So just 30 points of risk. And of course, from 1.14, I just take profit at 114.10. That is all. Redo the entry 114.15, for example, take profit 114.22, 7 points, and then stand down. Never move above 61.8 between resistance 1 and the pivot. Wait for a retraction and see if the market is going to reverse to the downside in the trend or still break out higher and recur the protective hedges. Okay, of course, let's take a look now at the target again, assuming this is in the trend, the target to the downside, of course. If this is correct, I will check the levels and the pattern. The pattern is a leading diagonal. The trigger is not there, but assuming this was a trend, I would be using this trigger. Rejection at this expected to be a trending trigger, of course. Rejection at a level 1.4, but again, this is not a trend, just assume it is. Then I am using a trending trigger, continuation in degree 3 negative momentum should be there. I am setting the upper boundary of the pattern, the upper boundary of the leading diagonal. All right. I am setting the level now to check the levels. I'm setting the pivot. I am going to be able to support 1. I'm not going to support 1. I'm going to 38.2% above support 1. So I'm selling 1.1370. I am taking it to 1.1320, 50 points. And the risk is at 30 points. And of course, if I'm a very aggressive trader, I can recur. So I can sell 113.70, take profit 113.60, sell again 113.75, take profit 113.55. All right. And recur as the market rejects and then begin to take sell stops after selling my sell limits and so on. Okay, so what do we get out of this? We get something, a new term that we're going to be using called the data set. What is a data set? Because I've done these labels, what are these labels? They are related to the levels of the momentum histogram. The levels of the momentum histogram. Remember, I'm trading levels. So I can give them numbers. I'm trading between 1.1362 to 1.1447. Is this sounding meaningful or comfortable? Not really. But I'm trading below level 1 to attack a level 3. Mix direct contact with the trader's understanding and with the trader's perception. And therefore, these numbers directly refer to a count that we'll be looking at how to do as we move forward out of the momentum histogram. Directly, these numbers relate to numbers and the cycle levels that have been confirmed by these numbers out of the relevant momentum histogram. Okay, so that's why they are a data set. They give you the exact number where you're going to be entering shorts if you fail below that number on the recorded histogram. If I fail below .1, I don't have to tell myself I've actually failed at 68.28. and that I'm going to be moving lower because I'm registering lower numbers. I'm now registering minus 63. No, I will tell myself I have failed dot one, failed the level one. And therefore, cyclic wise, I'm going to, there is, this cycle is still working. This one here that did a 1 and a 3 is still doing another move to the downside. So the numbers are a data set referring to directly, referring to the relevant momentum histogram or momentum plot that we're trading. Okay, so as of now, whenever we say use the data set, immediately the trader or should know, the trader working on an Elliott momentum segregated count should know that we are referring to the internal labels, a dot one, a dot two, a dot three, and a dot four must be showing, all right? And an ABC must be also showing because this is the cycle you're trading. Actually, the trader all day long, we traders short term all day long are trading this A, B, and C. If we take a long position trade long, we'll take it and let it run over the coming 36 hours. I will not be trading it all day long. I will be in a position that I am quite sure that the bounce has occurred and that it is the right trade to buy and hold. All right, so I will still be using a data set, but not as severe or not as important to confirm as a short-term data set. A short-term data set, of course, must be very as accurate as possible because if anything goes wrong, the stop loss or the hedges are very close to the entry, and therefore we actually make money very immediately, or we lose money immediately, or we are bogged down in a position for the rest of the day. So the data set, the daily data set, must be very clearly identified, and that's why we will call it focus on the data set. Focus that you're trading the data set. It's an A, B, and a C. Right? Looks like the same cycle moving to the downside, but for us short-term traders, we don't really care. We don't really now want to investigate cycle structures. We just understand that the higher degree motive is an A, B, and a C, and we are trading like C, and that C does a data set dot one, dot two, dot three, dot four, dot five. We're trading dot five over the coming 2 hours. All right, Christian Lagarde can talk for 1 hour, and the market will not move much except from current levels to 1.1328, maybe even lower. If you do a moderately good size, we make money, right? Whereas position-wise, other traders, even ourselves, will have to wait until we see these levels, because it is not really a good idea to buy before you see a bounce, and we don't see a bounce. So short-term traders, they have to make money on a daily basis, will have to use a data set, and that is the relevance of or importance of the data set. Okay, so today we are not doing a short-term trade on this because we can do better short-term trades with US Tech 100, I believe, and better position trades with Bitcoin, even better short-term trades with Bitcoin. But we can do position trade here, like we were saying earlier, if we get to, remember these levels on the 45 minutes, 1.1248, sorry, 1.1280, I believe, and 1.13. Do we ever get these here? Let's check that. 1.1280, of course, is right there, 200%, very likely to be seen. And there's one big marker here. It must be level 1 or something. And 1.1230 is support 2. That is the lower boundary, of course, of the wedge. Okay, so if we're going to be taking a position trade, we have to wait, all right, until we get to the favorable level or until we get a trigger. We don't yet have a trigger. A trigger, of course, is positive momentum on the 3 and 5 minutes. We don't yet, degree 3 negative momentum. We have neither on the 3 and 5 minutes. All right, but now we understand in a way we have introduced, we hope to have introduced a better understanding of how to use the internal levels by relating them to a data set, by labeling them in a data set, how to use internal levels to make short-term gains. Making short-term gains is very, very extremely important in short-term, in trading in general, actually, and of course for us retail traders, because short-term gains mean I just sell level 1, I just take 7 points below level 1, and then I go back and sell level 1 and take 7 points, and then I go back again. You do this numerous times. And even on a short size, if I'm just selling 1 mini, right, in this case here, 1 mini will create $7, multiplied by 3 times $21, and the gains begin to accumulate, and it's very manageable. And it all depends on using the data set right, using that 1, 2, 3, 4 right. If you break level 1, then you reverse whatever you've been doing. You begin to buy above level 1, take 7 points. Everybody gets the idea. If we have the data set, it has power. You are really able to trade short term, very small size, gradually as you progress, very big volume. Brokers will give traders rebates for these traders who trade millions, who trade very big volume. And actually, you may think I will never be able to trade a million. But if you consistently trade a small lot numerous times, you will get a good rebate because you are turning out very big volume when you add up all of your entries and all of your trades. A rebate is a bonus for heavy trading. So for those of us who have not used it before.